Welcome to Talk Tickers, your direct line to actionable insights from earnings calls. Today, we're diving into Agilent Technologies, Inc.'s Q3 fiscal year 2025 results. That's ticker A. Our mission, as always, cut through the noise, distill the most important nuggets, and give you a clear understanding of where Agilent stands and maybe where they're heading.
Absolutely. And it was a quarter with a lot to unpack. You had some strong top-line numbers, definitely. But the market reaction was, let's say, rather muted. So we'll definitely explore what might be driving that dynamic.
Okay, great. Let's unpack this then, starting with a snapshot. Agilent's Q3 FY 2025 headline financials. What jumped out?
Well, on the earnings side, you saw GAAP EPS come in at $1.18. Now, that's a pretty healthy 22% jump year over year. The non-GAAP number, which is often watched more closely, was $1.37. That beat the consensus estimate just barely by a penny at $1.36. Still, it shows a 4% year-over-year increase.
Right, a penny beat, but still a beat. And the top line?
Revenue. Revenue was quite strong. It hit $1.74 billion. That significantly exceeded the consensus, which was floating around $1.67 billion. So you're looking at reported growth of 10.1% and, importantly, core growth of 6.1% year over year. That core number strips out things like currency effects.
Got it. 6.1% core growth. And what about margins and cash flow?
Okay. Operating margin landed at approximately 20.7% for the quarter. Pretty solid. And looking at capital returns, year-to-date operating cash flow was robust, $1.01 billion. They've been giving it back to shareholders, too, about $340 million in buybacks and $212 million in dividends so far this year. Their balance sheet looks healthy. The net leverage ratio stands at just 0.9. Oh, and they also flagged a 100 basis point improvement in pricing year on year, so getting about 1% more for their products.
Okay, so strong revenue beat, EPS basically in line, maybe a touch better, and solid cash flow. On paper, that sounds like a really powerful combination.
It does, which makes that muted market reaction even more interesting to dig into.
Exactly. So let's do that deep dive. Here's something I found really interesting. This marked Agilent's fifth consecutive quarter of sequential core revenue acceleration. It went from 1.2% in Q1 to 5.3% in Q2, and now this 6.1% in Q3. What does that kind of accelerating momentum signal to you?
That's a fantastic point. It's really quite striking. It suggests, first off, that the underlying demand for their instruments and services is, well, very strong and potentially getting stronger. It also says a lot about their execution, being able to consistently convert that demand into growing sales. And their two-year growth stack is also improving, which points towards more durable momentum, not just a one-off good quarter.
And this wasn't just one hot product line carrying the load, right?
Not at all. That's what's really fascinating here. It was genuinely broad-based. All three business groups, Agilent CrossLab Group, ACG, Life Sciences and Diagnostics Group, LDG, and the Applied Markets Group, AMG, they all saw growth. And it wasn't just one region either. All geographic regions experienced growth.
You break down those groups quickly. Where was the strength?
Sure. ACG, their services and consumables arm, led the way in revenue with $744 million. And it had that really impressive 33.3% margin. Core growth there was 5%. That's often seen as their stable base. Then LDG, Life Sciences and Diagnostics, brought in $670 million with a 17.6% margin. That showed 7% core growth. That was led by strong performance in LC and LCMS instruments. Those are core analytical tools. And also NSD, their nucleic acid solutions business, which grew in the high 20s. Very strong there. And finally, AMG, Applied Markets, contributed $324 million with a 21.8% margin, growing 5% core. They saw good demand for GC, GCMS, and spectroscopy platforms. Think environmental testing, food safety, materials science.
Wow. Okay. So really firing on all cylinders across the board. Management gave a lot of credit for this to their Ignite Transformation operating model. They called it a differentiating growth driver. Yep. What exactly is Ignite doing for them? Is it just cost cutting or something more?
Well, they position it as much more than just cost cutting, though efficiency is part of it. It seems to be about embedding process discipline, really boosting commercial intensity, and finding ways to leverage the full scale of the company more effectively. They actually gave some specifics. They said Ignite delivered value-driven pricing results that had twice the impact of last year. That's significant. They also mentioned reducing management layers by over 15% to, increase speed and agility. And they're apparently seeing double-digit savings in key cost categories. So it does have tangible results.
Interesting. So internal efficiency is clearly a focus. But what about external pressures? You mentioned tariffs earlier. How did they navigate what they call the dynamic tariff environment?
Yeah, that was a key point of discussion. It seems tariffs became a bigger headwind than they initially expected for fiscal 25. They're now projecting about $20 million in net costs from tariffs for the full year. That's up from what they previously thought would be a minimal impact. Why the increase? Well, higher shipment volumes played a role, building some inventory for Q4, and critically, there was a new 50% tariff increase on European imports announced back in August.
Ouch, 50%. So how are they planning to deal with that $20 million hit?
They expressed quite a bit of confidence, actually. They believe they can fully mitigate these impacts by fiscal year 2026. The plan involves some supply chain reorganization, probably shifting production locations for certain things, and using targeted pricing actions where possible. So absorb the hit this year, but neutralize it going forward. That seems to be the strategy.
Okay, that makes sense. Let's shift back to the demand side, the end markets. Pharma looks strong.
Very strong. Pharma grew 9% overall. And within that, small molecule research and manufacturing showed double-digit growth. What was also encouraging was commentary about how lab managers are finding it easier to access and spend their capital budgets. Apparently, less need for multiple layers of executive sign-off, which can really speed things up. They even hinted at early signs of a, quote, standard year-end spend pattern in pharma, suggesting maybe some return to normalcy in purchasing cycles.
That is a positive sign.
Yeah.
What about other key markets?
Chemical and advanced materials also performed really well, up 10%. Drivers there included capacity growth, partly linked to supply chain regionalization trends, new greenfield investments, so building new facilities, and it's just ongoing replacement cycles.
Yeah.
Particularly strong demand noted in the semiconductor and broader chemical sector.
And innovation. Any specific new products really making waves?
Yeah, innovation continues to be central. The Infinity Tree LC platform, for instance, delivered mid-teen growth. And importantly, they noted early adopters are coming back for larger follow-on purchases. That's a great sign. The newer ProIQ LCMS system is apparently tracking well ahead of their launch forecasts, winning key accounts, including major pharma customers. And the new Dako family is expanding their pathology platform, making it suitable for a broader range of lab sizes. Underpinning all this, their instrument book-to-bill ratio was above 1 for the 6th consecutive quarter. Demand is still outpacing supply.
6th consecutive quarter. Wow. Okay, so strong demand, innovation paying off. Let's talk guidance then. How did all this translate into their outlook?
Right. So guidance is where you see the balance. They raised the full year FY25 revenue outlook quite significantly, now expecting $6.91 to $6.93 billion. That translates to core growth of 4.3% to 4.6%. So clearly confident on the top line.
I sense a but coming. The EPS guidance didn't get the same boost.
Exactly. Despite the higher revenue forecast, their non-GAAP EPS guidance for FY25 remained unchanged at the midpoint. The range is still $5.56 to $5.59. So essentially, they're absorbing those higher than expected tariff costs, plus some increased variable pay linked to the strong performance, and also funding some incremental commercial investments. That extra revenue isn't flowing directly to the bottom line this year, it's being offset.
Okay, so that explains some of the market's hesitation, perhaps. Managing expectations on profitability for this year. What about Q4 specifically?
For Q4 FY25, they're guiding revenue between $1.822 and $1.842 billion, and non-GAAP EPS between $1.57 and $1.60. But here's a key point. They anticipate a significant sequential operating margin improvement in Q4, roughly 230 basis points higher than Q3. That's expected to come from higher sales volume, giving them better leverage on fixed costs, plus more benefits flowing through from that Ignite program.
So a strong margin finish to the year is expected. What about looking further out, say into FY26? Any hints?
It's definitely too early for a formal FY26 guidance, but management sounded pretty positive. They see the strong second half of this year providing a solid foundation for continued growth next year. They also explicitly mentioned M&A, mergers and acquisitions, becoming potentially a more meaningful part of their capital deployment. Disciplined, aligned with strategy, but perhaps bigger deals are possible.
Interesting. Any specific geographic focus for next year, maybe?
They did mention China specifically. They anticipate a more meaningful stimulus impact there, but likely towards the end of calendar year 2025, mostly expected in the applied markets and tied to this new quality productive forces policy the government is pushing, which emphasizes innovation. So maybe a tailwind building there for late 25 into 26.
Okay, let's pull back and look at the investor context. Agilent stock, as we know, hasn't kept pace with the S&P 500 this past year, down about 15% versus the market up over 16%. The whole healthcare sector, XLV, for example, has lagged too. So you have this strong revenue beat, raised revenue guidance. Why the flat after-hours reaction, just down 0.2%?
Right. That's the puzzle, isn't it? It really boils down to the bottom line, I think. While the revenue story and the strategic execution points like Ignite are positive, the market seems laser-focused on near-term profitability. The fact that EPS guidance wasn't raised despite the revenue beat because of those tariff costs and investments, that likely tempered the immediate enthusiasm. Investors saw the good news on sales, but weighed it against the near-term cost pressures.
But the underlying feeling seems to be, as described, constructively bullish, because the growth story is intact.
Exactly. The broad-based nature of the growth, the accelerating trend, the positive outlook, those fundamentals are strong. The muted reaction might just reflect that the good news on revenue was perhaps somewhat expected, while the cost headwinds maybe weren't fully priced in yet for FY25.
So what should investors watch for as near-term catalysts? What could move the needle?
Well, the Q4 earnings print itself will be key, seeing if they deliver that expected margin uplift. We'll also want more updates on tariff mitigation progress. Are they on track for that FY26 neutralization? Continued commercial traction in pharma and chemicals is crucial. Any signs of further acceleration or deceleration there? And maybe some insights from their upcoming appearance at the Wells Fargo Healthcare Conference on September 3rd.
And longer term, what's the multi-year story shaping up to be?
Longer term, it still looks like a story of steady core growth, probably in the mid-single digits. Continued improvement in the sales mix, driven by the higher margin CrossLab services business. Ongoing productivity gains from Ignite, assuming that continues to deliver. And sustained capital returns, plus that potential for larger strategic M&A down the road. They seem to feel they are ready organizationally for bigger deals now.
Okay. That sets the stage nicely. Shall we move to our This Is Not Financial Advice segment?
Let's do it. Time for some outrageous but plausible trade ideas, the kind you might brainstorm internally. Remember, folks, purely for discussion.
Absolutely. Idea number one.
Okay, first idea. Consider a long call spread on FY26 margin expansion. Now, Agilent is projecting potentially over 100 basis points of operating margin expansion next year. That's quite significant. It hinges largely on fully mitigating those tariffs and getting continued benefits from Ignite. That strong sequential margin improvement they guided for Q4, the 230 basis points, could be seen as a preview or a proof point. So the trade idea is that the market's sort of flat reaction now might be overlooking this potential earnings leverage coming in FY26. A call spread lets you bet on that upside, but with a defined risk. You buy a call, sell a higher strike call, same expiration, limits your gain, but also limits your loss if you're wrong.
Interesting. Betting on that margin recovery story playing out next year.
Okay, what's idea number two? Second idea is a strategic pairs trade. Long Agilent, A. Short a healthcare services or devices ETF, like maybe IHI. The thinking here is differentiation. Agilent has specific growth drivers, new platforms like Infinity Tree, ProIQ, the strength in Agilent Diagnostics. Meanwhile, the broader healthcare equipment and services sector, represented by IHI, has been lagging, as you noted. Agilent's management talks about a laser-like focus on profitable growth, and their execution seems pretty strong despite headwinds.
So the trade logic is?
You're essentially betting that Agilent's specific strengths, its innovation, its market positions, its ability to manage challenges like tariffs will allow it to outperform the broader, more generic healthcare device and services sector. Even if the whole sector faces headwinds, the bet is Agilent navigates them better and its specific drivers shine through, leading to relative outperformance against the ETF. Long Agilent, short the basket.
Got it. A relative value play based on execution and specific growth drivers. Okay, interesting ideas. So let's recap. Agilent put up a strong Q3, beat revenue expectations pretty handily, raised the full-year revenue outlook. Growth was broad-based, all segments, all regions, and that Ignite Transformation seems to be delivering real results.
Right. But tariffs emerged as a bigger headwind for this fiscal year, offsetting that top-line strength on the EPS line for FY25 guidance. Management seems confident they can fully mitigate that tariff impact by FY26, setting up for potentially strong margin expansion then. Innovation pipeline looks healthy, demand seems robust, particularly in pharma and chem advanced materials, and they're signaling readiness for M&A.
So as you, our listeners, digest all this information, what stands out? How do you weigh that strong current growth and future potential against the near-term margin pressures and the execution risk on mitigating those tariffs?
Yeah.
Where does Agilent fit in your view of the market?
And just a reminder, as always, this conversation is purely for informational and discussion purposes. It is absolutely not financial advice. Please always conduct your own thorough due diligence before making any investment decisions.
Well said. Thank you for tuning in to Talk Tickers. We look forward to digging into the next set of earnings with you soon.